Hey guys, Tanner over at CMG. Just wanted to go through a unique and beneficial mortgage program called the All-in-One Loan. This is actually the mortgage that I have on my permanent or primary residence. Frankly, if it fits you, it's the best program that's available. It's amazing how much faster you can pay off your house and get out of debt. It's amazing how much less interest costs you can have with this program compared to a normal mortgage. And the way that it works with a normal mortgage, you obviously, as I'm sure hopefully most of you know, the first usually 20, 22 years that you have that mortgage, you're paying more interest on every payment than you are principal. If you just pay your normal mortgage across the board. So obviously the first number of years on a normal mortgage are super expensive. It's almost it's a very large percentage of that is going to go to interest instead of principal that you're building within the property. The all-in-one loan is actually designed to switch that. Okay, so it flips everything on its head. It actually combines a bank account with your mortgage, and every dollar that goes into that bank account, just like a normal bank account, um, pay stubs, investment statements, whatever comes in, if you sell something, that money automatically goes against your principal balance that you owe on your mortgage and reduces the amount that you show that you owe. And in the all-in-one loan, you only pay interest on the balance that you show on average throughout the month. So if you're continuously putting pretty good amounts of money into that account, paychecks, all that different stuff, and on a regular basis, you're not spending all of your money, which is a pretty big key. You have extra money hanging out in that bank account on top of what your mortgage payment would be, and it dramatically reduces down your principal balance without you having to change your budget or do, anything extra. So I just wanted to show you a little basic example. So what I did is I took a household in South Dakota here. So this is a two-person household, two-income household. Both people make a little over 50,000 a year. So I didn't do anything crazy, fairly standard incomes. And we took that money and obviously put it into the bank account that goes with the all-in-one loan. So you can see here the repeating deposits are put in from their paychecks. They also, in this example, had like 25,000 in checking and savings and so on, other accounts that they had that they can use and move over to this savings account as well. And on a expense basis, like I said, they're pretty good at not having all their money get spent every month. So in this example, you can see here they have about 15% of their total income that just isn't getting blown on stuff they don't need, being more or less kept in their checking and savings account. Pretty good savers. If we use this all-in-one loan and we compare it to a normal mortgage, so in this example, what I did over here on the right, you can see traditional mortgage. I gave them a 30-year conventional loan at a 4.25 interest rate, so much lower rate than where we're at today. And I said that they had already owned the house for about a year and a half. So they've got about 28 years left on payments on this mortgage. And you can see total expense over here of 431,000 bucks based on them having a $250,000 loan with this property. So that over the 28 years, they'd pay 181,000 in interest, coinciding with them paying 431,000 in total expense for buying that house, both principal and interest payments that they pay back. If we go over to the all-in-one loan, you can see that the payoff timing in this scenario, just by them leaving the extra money that they don't spend, on stuff in this bank account, helping show them having lower balance, it knocks their payoff time frame down to 11.8 years. And again, I'm not doing any crazy income or anything like that. So this is a normal example that we see on a regular basis. And even with interest rates higher today than, and will be more than likely than where that 4.25 rate is that they have locked in, the total interest cost in this example is about 104,000, which means that they would actually save if rates did what they did and they paid it off in this 11.8-year time frame, they would total save about 77,000. So if you can imagine not needing to change your budget, qualifying for this program instead of a normal mortgage, You can have your house paid off in less than 12 years. A lot of people, less than 7 years, and save a whole bunch of money in interest compared to your normal mortgage. And again, you don't need to change your budget or do anything crazy. Just because we switch from a principal first or from an interest first mortgage, traditional mortgage, to a principal first mortgage in this platform. It's pretty amazing. Again, this is the program that I use on my primary residence, and it saved me a lot of money. So any questions on this, obviously let me know. You can see here over on the top left, if you want to go to just the basic website, I'll go back to the home page here. It's just the allinOneLoan.com. So you can go get some basic info together. If you do want to get more advanced info, figure out if it's a good fit for you, obviously talking to somebody at CMG is going to be the key. But hopefully that gives you some ideas on different tools you can use to get out of debt much faster, get out of your mortgage much faster, save yourself a whole boatload of interest, so on and so forth. Tanner with CMG.